Good morning, guys. Brian's here. Today is Friday, November 21st, 2025. The market is not yet open, so I'm going to try and squeeze this video in before the market opens. This is going to be an update on the positions that I shared in yesterday's video. I recorded a video on how I manage swing trades with a busy schedule. This video was recorded during the morning session yesterday. However, after I was done working on that video, the market actually took a massive intraday dive. This is what I would consider a intraday black swan type of move, as the market was down well over 3% intraday from the intraday high. So we'll call it 3.3% drop. This is over 220 points on the SPX. That is a massive intraday drop. We're talking about within the span of just a few hours. That's not normal. Now, my positions, if you guys remember, the main reason I opened them is because they had no downside risk. So I'll show you guys just from now. We'll also take a look at some new positions which I opened, but this is that same position here. I essentially did nothing with the trade. This is, again, Friday morning. Let's just take a look at the extended hours and see what the market is doing. So we ended up going down to what I would expect to be the last major support for the week. Again, I plot this out from Monday's morning, so this is well before the market gets to any of these levels. I essentially have my roadmap for the week, and then I share them within the Quant Trading app Discord. So knowing this is what I would expect to be the major support for the week, I addressed my trades, or I assessed the risk associated with these parameters. However, whenever the market has any signs of showing that it could sell off aggressively, I don't try to get cute with trying to pick exactly where the bottom is. I want no real risk to the downside. Now, there was no way for me to know this was going to happen intraday. No one can know when the market is going to actually do an intraday black swan type of a move. We're talking about something that happens once in a blue moon. But to protect myself, because my busy schedule and because I'm not micromanaging these positions, there was no real risk for me. So this actual position here is up currently still around, we'll call it $400. At the same time, the SPY, which was my call ratio spread, as you guys can see, I'm still in that same one lot, is down $200. So it's not a major big win for me right now. Now, once the market opens, these numbers will adjust a little bit and there'll be some micro changes. But for the most part, when I created these spreads, I created a scenario in which I said I like to try to create these opportunities in which is actually hard for me to lose money. Remember, this hedge was created to protect myself from the upside, but I think I forgot to mention this in the previous video. There is really no risk to the downside if this is held until expiration. So let's just say the market was to be down 10%. I honestly would not really care. It would actually be good for this trade if the market was down, 5-10% or whatever. It can go all the way to zero for that matter. And the same thing with this, if the market went all the way down 5% or so, that's actually a really good scenario for me. So even though I'm not bearish, I'm not scared of a bearish scenario. Honestly, as the market was selling off yesterday and I was finished with the video, I was actually working on the video around this point here before moving on with my day, and I did really nothing while the market was going down. I ended up with a massive migraine later in the day, and I had to shut down some of my charts, which is the main reason why the video that I recorded yesterday morning went live after the market closed later in the day, is because I could not look at screens for a bit. My eyes were hurting, and the way I experience migraines is I start losing a little bit of vision. Everything just starts getting blurry, and my vision starts shrinking and shrinking to the point where I actually go almost completely blind. It was scary when it first happened, and that's because I didn't know what I was experiencing. But I do know that is sort of the caveat or the downside of obviously what I do when I don't rest that much. So this is the exact comment here. I'm just not showing the person's name just in case, I don't know, I didn't ask them if they wanted to have their name showcased on a YouTube video. Not that it matters, it's all in the public domain anyway. But how do you sleep, without ever dropping the ball, juggling all these things? Yeah, I do drop the ball at certain times, and usually my body shuts down or I pay for it in some type of way. But this is the update to address exactly this question, because I figure it's a really good question to figure out, these types of unconventional spreads. What happens when the market produces some sort of a black swan event and everything goes south? The main point of what I was trying to showcase in the previous video is I kind of thought of about as many scenarios as I could have think about when I first initially opened my trade. The swing trades, they started last week, Friday, after the market closed here, before knowing the market was going to do something like this or all of this. But it didn't really matter because this is all within the parameters that I was expecting something like this happened. As I addressed in the previous video, just by taking a look at this week's gamma exposure profile, it would have been foolish of me to think that the market was just going to start the week and then go straight up to my target. I figured it would have been a very difficult, kind of chaotic type of week, as I just addressed in the previous video by looking at the upcoming week's gamma exposure profile. I like to look at it as almost like I'm looking like at the forecast for the upcoming week. If you check out the forecast for the upcoming week and you see the chance for a lot of thunderstorms and a lot of cloudy weather and so forth, then you're going to dress accordingly and plan accordingly. You're not going to expect a bunch, you're not going to expect it to be a time to go to the beach tanning, because that's not what the forecast is telling you to do. So if this is sunshine and roses up here, I'm not expecting to go tanning, but hey, if it did get up there, that would have been a mega win, which would have been in this region here. Now, as this position here, I've done nothing with the SPY, with the SPX. Oh, and the XSP, that was the other position I think I addressed. I don't have any other XSP positions open. But if you guys remember, I was targeting 60, 70 on the XSP on the SPX. So at the time, the market was actually above that level. Let me just pull up the SPX. Market, when I was recording the video, was in this area, and the XSP actually, this was the high peak for maximum profit for that broken wing butterfly. So it actually increased in profit as the market pulled back right to the maximum profit zone. And I think, if I remember correctly, at that point it was up about $110 per lot, and I was in 2 of them, so for how things went there. And then I think the break evens for that butterfly was back around here. You never want to trade a swing trade, go from red to green on you, and try not to get greedy. So the XXP wasn't really much to discuss there. But for the SPX, what I did do is just ask myself, hey, I know this is not going to be a big week for myself now. I'm going to walk out, as I said in the previous video, probably with a couple $100 if the market did tank. I was actually looking for the market to at least hover in this area or go up a little bit more. I did open up another diagonal call spread, but this time for next week, just run it back again. And that's the beauty of this. Like, I'm not really at much risk, but I'm still looking to have a nice reward, because the market can keep selling off. I'll keep doing this for credit as long as the implied volatility is structured in which the way it's structured, in which these call diagonals are working pretty well. And once the market does finally have a really good week, let's see here, if the market was to go up, let's call it I don't know, 3% or so, and let's just say by where we're at from now to next week Friday, obviously this is not accounting for any changes in implied volatility. We're just looking at a theoretical potential profit. Maybe the market recovers and it's up 4%. And it takes an extra day to do so. The market is actually closed, I think, next week, Thursday here, for Thanksgiving in the U.S. But there's still room, and this is a 4% move, that's already asking for a lot. But regardless, it would take the market being up at this point, I don't know, over 5% or so before this trade can potentially start turning red by Friday. So it's not something that I'm not worried about. Even if the market's up 5% by Monday, again, with no adjustments to implied volatility, we're talking about less than $500 in risk, which for me that's well within my personal risk parameters. I'm not concerned with that, but I still have the call ratio spread. And what do you guys think I'm going to look to do towards the end of the day today? I'll look to open up another call ratio spread if I think that it's too risky to hold that call diagonal spread for next week Friday. Now, the beauty of why I didn't even hesitate to open at this one, let me see, I don't remember what time I opened this because my brain was all jumbled. So I opened it sometime in the afternoon here, so around 124. What I liked about it, I was able to get a credit. That was the significant thing. I was able to target just about the same place. So I'm still targeting this, we'll call it 800, but like I said, I just went a little further to 825. It's the same thing. So it's almost comical. Like, I feel like I'm just playing with the market at this point, and it's not, with all the chaos and the stress that's happening, not only in the market, but in my personal life. I have more location scouting to do today and more meetings. Again, I have a short film coming up in December that I'm shooting. Fortunately, I'm not producing this one, but I still have to meet with the producer today. And a short film like this, we're trying to shoot 19 pages in 4 days, in 3 days, which is, if anyone works in the film industry knows how aggressive that is. It's in a cab cast, the main ensemble of 8 leading actors, and we're dealing with about 15 potential extras and probably a crew of 10 to 15 people. And we're looking to shoot in some sort of Tribeca style apartment. So there's a lot of logistics to figure out. The production dates is only a few weeks away, so my schedule is only going to continue to get a little bit more chaotic and busy. I can't be too stressed out with what's going on in the market, otherwise I will drop the ball on everything else around me. And obviously with that production, as a director of photography, there's a lot of people that are looking towards what I am able to do on that production, and there's only one director of photography on a project, so I have to make sure that my head is clear and I have the energy levels just to get through those production days. The production day is going to be about 12 hours on sets, but for a DP it's probably about 14 to 15, sometimes even 16 hours. These are overnight shoots, which means we'll probably be starting to shoot at 4 p.m. and then I'll be wrapping at 4 a.m. in the morning, getting home maybe around 6 a.m. The market's going to be open at 9:30 a.m. So I can continue to trade the way in which I trade just by looking at gamma exposure, just by looking at the edge that I have from my analysis at the start of the week, and then I'm just setting my alerts and tweaking here and there. So I open up this in case the market does decide to recover. But if, let's just say overnight, the market did a complete 180 and ended up bouncing and going right up to where I was initially thinking. So we're talking about, if we take a look at this here, the market closed, right? So imagine if for whatever reason the market was up an insane amount today. Let's just say some extremely bullish news came out and the market is up 4% today. This is what my risk profile would have looked like with just these two positions open. So if the market was up 5%, did we say 5? Or let's see, from here to, we would more than likely get stuck, I would imagine, around here. So let's use 4% and take a look at right where that lands, right? So this is, remember, this is today's P&L curve. So this is at expiration today. That's what this level is. This is the T plus 0 line. So at expiration today, this is, I don't know, call it 20, we'll just round it. I like to be modest and just round things down or so. So let's just say $2,500, you know, during the last 30 minutes of the market open today is the type of profit in which I would be potentially looking to make if the market was up 4% for some crazy reason overnight. If we take a look at the SPY and say if the market is up same 4% today, this position is equally up. So we're talking over $3,000 in profit. I'm using the exact dollar amounts in this video as I normally don't do. I like to mention things in a level that anyone can scale up or scale down. But in this case, I'm showing you guys my exact position sizes in the exact trades in which I'm swinging and my thought process behind it. But that's not a bad scenario. I would have loved for the market to be up 4%. I wouldn't have cared if the market was down 4%. If it's up 5%, I'm very happy. If it stays here, well, it's a modest week for me, and I'm cool. And, you know, it means I walk out with a couple $100 on this campaign in which I ran. Again, there were some 0 DTE, MES scalps here and there, and so some other shorter intraday trades. But I like to have some sort of a bigger position or thesis in which I'm trying to manage. This helps with scaling up and portfolio management and that type of stuff, especially with the personal goals of trading on an account that is a portfolio management style of account with a lot more capital and margin and borrowing power. That's something that, you have to think about safety and all these different types of scenarios. Not that I'm looking to trade with client money anymore, but if I was, and if I were trading at some sort of a fund, this is the type of things you need to be able to think about and account for if you're explaining to your superiors at a firm what's going on or why something, why you open a position. There's no way your boss at a firm would let you run something like this in the current market climate without some sort of protection or a hedge. And with the SPY being and serving as that protection as a hedge, that can potentially make a lot of money. Then you're going to get the approval for the funding that you need to run some sort of a trade like this. Now, lastly, in the chaos of it all yesterday, I did see that I did open up another trade. To be honest, I barely even remembered this. That's how chaotic, things were, especially after the market closed. I had to move on with other things, and I honestly did not even remember that I opened up this. But this is a put diagonal spread here that it looks like I opened up. Also, this trade is pretty much at a break even, which is the other bonus. There's so much leeway with these types of trades and the way in which it's structured, and that would be This is the call ratio spread here on option strat, just so you guys can see it. But I did open up this one, and this one is for 2 weeks out. I think I was looking at the 200-day moving average. So if I remember correctly, the 200 daily moving average on the SPX is somewhere around 6,200. And I figured, hey, why not? For $240, one lot, contract, I got filled for $240. If I updated, this should be the updated price here. It's a debit, so it's not a credit, because with the put side, again, I'm not looking to be too cute with this. I already have enough upside protection and so forth, so I can pay that $2 and change for if the market did bounce or recover. It wouldn't have mattered. As you guys can see, I would have been up well over a couple $1,000s, so this would have seemed like nothing to me. But it was the joke of what happens if over the next week the market does put in another 5% drop or so, and we do go to the 200 daily moving average. This is very cheap for a position like this, and if the market goes nowhere overnight, I can decide what to do here today. So as you guys can see, it's pretty much in that break-even zone, and this is what I like about the leeway here. So if we jump forward to, let's just say, Monday, now again, this is not accounting for any implied volatility changes. The market opens in a few minutes. Not that there's going to be that much drastic changes with any of these types of positions, but even if the market was to stay here and slightly go up, I can walk out profitable. Maybe even if it's $50 on a trade like this. It's like I got paid $50 to potentially see if the market was going to go down 5%. And if the markets did recover and bounce, it wouldn't have mattered that much, because I'm going to make so much profit from the main thesis that I have. And at the same time, the call ratio protects me from a black swan event to the upside. So it's, I'm just checking different basis points, and I'm thinking about things from a risk management standpoint. This is risk assessment. This is not just trading, and it's not something that is, how to trade this and that. Like, this comes with its maturity and experience as a trader, and knowing how to creatively manage and read your risk profile. So this is with all the positions turned on. You guys can see what it looks like here, and I'm just accounting for a 1% move up or down. It doesn't really change much here, at least for today. And then on the SPY, a move up or down about 1% here today has nominal effects. These numbers are eclipsed by these numbers, and the moral of the story is, one way or another, should be net positive, net profitable. And let's see where the market is right now before I finish wrapping up this video. My expectation at this point, the market does all this sort of crazy stuff in which it does, but I generally don't care. I have my plan at the start of the week. I'm not going to adjust any of this stuff here. I was expecting this to be massive support. This means this was the highest open interest strike and the highest strike price with the most amount of put open interest for all expirations aggregated for this week. That comes straight from Quant Trading app. As I will often share here in my notes at the start of the week, not only do I share my notes for the week, but also a recap on the previous notes, so we can see how the levels looked at the start of the week, what a person such as myself would have thought would have happened, and then what actually did happen. I've been doing this for a couple years now, this exact same way, and there's essentially, you become very comfortable looking at the gamma exposure profile. And when I see something like this, and I see 650 down here, and I know how much open interest there is at this level and how much put open interest at this level, then my expectation, regardless of what happens throughout the week, I see it as that's the blueprint for what was within the parameters or the expected parameters. But the thing to remember is, if there's a lot of puts that were sold at this level, then the break even for those option writers is actually a little bit lower, because the credit they receive for selling those puts actually makes their break even a little bit lower. So it's kind of a range around here. Sometimes it's not the exact level, but 660 obviously now is going to be a key area of interest if implied volatility does continue to decrease for the day here today. Then it's almost inevitable that the market will want to close at or above this level, and then we'll see how things go next week. But either way, I'm accounting for eventually some sort of bounce back up to here, and if that never happens, as long as I keep receiving credit for these call diagonals, that might be my strategy going into the rest of the year, while I can continue to give myself the opportunity to make at least a couple $100s for these swing trades, or all the way up to $2,000, while I continue to prep for this short film without completely losing my mind. Thanks for asking this question, by the way. I think it was pretty neat. I'm glad I had the opportunity here at the time to hop on. I have a bunch of other questions now to address, some stuff in QTA here, as well as my personal Discord channel for the people that attended the Gamma Exposure Workshop, and then again the Location Scout. So enjoy. Good luck trading today. This video, hopefully I'll try to get up pretty soon, and catch you guys in the next one. Thank you. All right, the market is officially open. As you guys can see, it's 9:31 here, and this is where the SPY actually opened. This is where the SPX has opened, and this is my P&L. Figured I'd just show it to you guys live here in case there were any discrepancies during the pre-markets trading, as sometimes the numbers, as the Greeks are not entirely updated yet, are not accurate. So the call ratio spread, that is the P&L currently, and the SPX, the total positions here, that's how much it's up currently. That's with all of them turned on. If I just, let me just turn off the longer dated swings. So this is what this looks like here. And I'm just going to turn all of these off. This is just for this week. That's what that's looking like. So it looks like opening up the other call diagonal pulled in a little bit more P&L, which was good. And then this one here has costed me nothing. It's up about 20 bucks. And it has some leeway. So yeah, obviously I'm not always going to be able to do an update style type of video like this, especially as I size up and start trading with like my actual size again after the holiday season and things are not as busy. I'm not going to be able to do this. I have to be, there's no way with the market just opening, I can come on and casually just show you guys this. I might have 3 other positions for multiple different expirations that will require me to be analyzing and making sure I'm not at too much risk. If we're talking 20, 30, maybe even $50,000 or something like that, that I'm setting goals that I would want to be running style campaigns of that nature and that style, I need to be entirely locked in and focused. But for the most part here, I figured I'd just show you guys this within QTA. Let's take a look at what's the let's turn back on our studies. I didn't update the script yet, but we didn't quite tag 2 sigma in the intraday session, so I would be lovely if we actually came down to 2 sigma, and then might look into potentially trading something for next week. It's much harder to record this video as the market opens, as I'm thinking a million different things right now, but let me just update the quant trading app scripts here to see what the new levels are. So here, just copying, pasting, and that's going to give us the update for today. And then let me just copy this here for the index and paste this in. Let's see where, okay, the 2-day anchored VWAP is all the way up here, so I would definitely expect that to be some sort of resistance if the market does get here. We have extra confluence at 2 sigma here today, with the intraday zone also aligning with it. We have some massive gamma below it. Let's see on the SPX. Similar deal here. Right beneath, there should be a lot of support in this area here. It makes sense. 500 is a very important level on the SPX, and it is a key gamma strike. We have some decent gamma, as we know, up of 66 level here. Sorry again, I'm mumbling because again, market's open. I'm watching other screens. There's a bunch of other stuff happening around me. But let me go focus in now. Figured you guys just might want to just see what does it look like with the market open. So boom, 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 and boom. All right, guys, take care.